It was a nasty day in the stock market as investors wind down this final week of the second quarter. Stocks dropped to a two-month low today, but it could have been a lot worse. The Dow was in the red all session long, swinging from an early decline of 248 points to just 25 points lower before settling somewhere in the middle. At the close, the blue chip average was nearly 140 points lower. The Nasdaq was down 36, the S&P off by 19 points. Now, the reasons for the sell-off today? Worries about China's credit problems, something that could shock its economy. And lingering worries here over the Federal Reserve's looming plans to trim back on stimulus in the U.S. economy. The market turmoil today also sent the yield on the benchmark 10-year Treasury bond to 2.65%, up a full percentage point in just a few weeks before easing lower.
And joining us now to talk more about why China matters so much to U.S. investors is Scott McDonald, Head of Economic Research at MC Asset Management Holdings. Mr. McDonald, welcome. Good to have you with us. We're just a half-hour program, so my first question, you could spend an hour on it, but I'll just ask you, what's going on in China, and why do U.S. markets and investors need to pay attention to it?
All right, we'll make a quick answer here. I mean, the bottom line is that in China you have a system which has been investment-led in terms of an economic growth strategy. The new team, Li and Xi, have decided to change that. They're going to pump more structural reforms into the economy. They're going to reduce some of the liquidity that has been pumped into the system. They want more accountability from the banks. You also have a question of how credible is this economic team going forward. So you have a combination of factors which is really coalesced right about now to make investors very nervous because China, after all, is the second largest economy on the planet. They own 1.2 or 1.3 trillion of U.S. treasuries, and most major U.S. corporations do trade with China. So what happens in China is something that is of keen concern here in the U.S. to everybody.
Well, are things unraveling in China, Scott? I mean, most people, when you say China, the name China, they think of this growth engine, lots of construction going on there, lots of money and lots of benefits to our economy and to consumers and businesses. Is it unraveling?
I don't think it's unraveling. I think there's still a lot of positives in the Chinese economy. You're sitting on, I think, 3.3 trillion of foreign exchange reserves. You still are one of the most powerful export machines on the planet. It is still the industrial workshop of the world. But what is problematic is you've had this long spurt of economic growth from 1999 to 2012. Chinese economy grew around 9.9%. And what you're doing is you're putting the brakes on that growth here. And growth probably over the next 5 years will slow to 6 to 7.5% growth. And what that means is a lot of parts of this economy that have done well are suddenly finding themselves with a very bumpy ride. And there are going to be real challenges ahead in the next couple of years as they sort the economy out in China.
I don't mean to overplay the analogy here, but it sounds like what's going on in the United States in terms of a transition in monetary policy is precisely what seems to be going on over in China. And just as we have had an awful lot of debt-fueled growth in this country, so have they in China, and that now they want to substitute debt-fueled growth, to substitute really demand-fueled growth for debt-fueled growth.
Absolutely. I mean, in essence, what the new government in China is doing is taking the punch bowl of liquidity away from the party. And as we all know, without a punch bowl, a lot of parties die. And this is the issue all of a sudden the Chinese are facing is, okay, fine, we have to have more organic growth. We have to move away from just large state corporations that hog credit markets. We need to have more entrepreneurs in the economy. There's a lot of things that need to be corrected there. And I don't see China totally unraveling. But like I said, it's, growth is going to be slower. And the other aspect is this government, in some ways, does not have a lot of room to maneuver. And by that, I mean, it's real simple, that they have to maintain credibility on one side, but they have to make the structural changes on the other as they reduce liquidity.
We have to leave it there. Mr. McDonald, thank you very much. Scott McDonald is Head of Economic Research at MC Asset Management Holdings.